Welcome everyone to Breakout Investors. Today we're speaking with the management of Crexendo, ticker CXDO. Specifically, we have Doug and Ron, who's the company's COO and president, and then CFO respectively. This call is being recorded on the 7th of August and will be distributed via the Breakout Investor channel on YouTube and via our Substack community. Supporting materials for today's discussion will be posted on the Breakout Investor Collaboration app. It's on the App Store and at breakoutinvestors.com. The application and much of the research content is free, so we hope you can join us. Let's get started. We're going to go ahead with our first question. Today we're going to be kind of reviewing the results that Crexendo just got out, and then we'll open it up to a Q&A session. So to kick things off, everyone has a chance to kind of look through the whole result, so I think there's no need to kind of rehash everything. But what aspect of the results, maybe you can pick out 2 or 3 things of the results that you were kind of most excited about to show everyone, for investors to hear about?
I think it was a fantastic quarter for us. We continue to show great organic growth. So the things that we're probably most excited about is one, the organic growth of 16% combined for the company. Most specifically, though, the 35% organic growth that we had in the software solutions segment of the business. And just to remind you and all of your attendees that we've got 2 segments of our business: the wholesale side, which is our platform side. That's the software solutions side of the business. That makes up about 40% of our total revenue. And then the telecom services side, which is the retail side of our business, which makes up about the other 60% of our total revenue. So that 35% organic growth in the software solutions segment was great. 16% organic growth overall was great. The fact that this is our 4th consecutive GAAP profitable quarter, we exceeded all the analysts' expectations. We've got 4 analysts that cover us, and we exceeded all their expectations out there by a large margin, I must say. And then the fact that our non-GAAP net income is up over 236% year over year. So we've really just got all of the metrics pointing in the right direction. And then finally, cash flow. So positive cash flow. We ended the quarter with $13.6 million, and that's up considerably. So those are probably my highlights. Ron, any other color you want to add to that?
Yeah, to echo those, the cash flow from operating activities of $2.5 million for the 6 months ended June 30th, as well as the almost $800,000 from financing activities resulting from stock option exercises, proceeds from those. So it's been a great 6 months of the year, and very positive EPS and adjusted non-GAAP EPS and adjusted EBITDA as well.
Great. And I forgot to open the call by asking you to kind of introduce the company in 2 or 3 lines. Do you want to go ahead and do that now? Just
Sure.
Because I forgot, sorry.
Yeah, nope, absolutely. Glad to. So if you're not familiar with Crexendo, we're a unified communications company, which is basically cloud communications. We do business telephone services using the internet as our backbone, so voice over IP, if you're familiar with that acronym. But we're kind of unique in the fact that we offer our services, as I just mentioned, in 2 different segments. Our software solutions platform is our platform that we've got 230 plus licensees using our platform out there, selling it as their own. And so that's a very, very sticky customer. Those 230 licensees have built their whole business around our platform and offer our platform under their name to their end users. And so that is the segment that's, again, growing by 35% organically. And then we also sell the same platform we package as our own Crexendo VIP offering. And we offer that on a retail basis to small and mid-sized businesses. And that makes up the retail component of the telecom services component of our business. Again, that business is growing significantly as well. The services section of that segment grew at 10% for the quarter. And we continue to see great growth in both segments of the business. But that's basically a quick recap. We do business phone services for small and mid-sized businesses on the retail side. And we also offer the platform to over 230 licensees today using it to run their business.
Thanks very much. So coming back to the results, one thing that you mentioned, and I think a lot of investors were really impressed with, you had good growth on your kind of direct to the customer side, on your retail side, but then on your kind of through the licensees software solution side, I think a lot of people were blown away by 35% year on year. It's just really phenomenal result. Just to kind of brings another aspect in, and then I'll ask a question after that. Is we also have kind of the news, which is that Microsoft's kind of shutting down its Mac Switch offering, and that should be a healthy growth driver for you to kind of pick up some more licensees. So what I wanted to ask was, have we started to see, and if so, how much have we started to see inflows from Microsoft in that 35% year over year growth, or is it predominantly driven from you just kind of just continuing to do well in other fronts, and we still have all those Microsoft customers still to enjoy in the future?
Yeah, I'll start with a little bit of color, and then I'll have Ron give some more granularity with the actual numbers. So that 35% growth has very little to do with the Metaswitch Microsoft challenges they're experiencing out there. So for the quarter, we added 4 new logos. One of those was the Microsoft Metaswitch licensee. So the majority of our business was not coming from Microsoft or Cisco at the time. And so when we look at the opportunities that you mentioned, Sam, so we are the 3rd largest platform provider in the country behind Cisco that owns BroadSoft. They bought BroadSoft 6 years ago. BroadSoft is the largest platform provider out there by far. They've got about 750, we estimate, licensees using their platform. Microsoft is the 2nd largest. They bought Metaswitch 4 years ago. We estimate they've got probably about 500 licensees using their platform out there. And then we're the 3rd largest platform provider in the country. We've got currently 230 plus licensees using our platform. So Microsoft recently announced a retreat and basically end of life on one of their main platform products, and basically a retreat from the telecom services platform division, and did a massive layoff with their Metaswitch employees recently. And it really kind of signaled to the market that that's not really an area that they're going to concentrate on. And so we're excited because that's really allowed us a lot of opportunity with these Metaswitch licensees. These Metaswitch licensees, just like our licensees, have built their whole business around that platform. And with Microsoft putting an end of life on the platform and not developing it, it's really signaled to these licensees that they need to start looking for an alternative. Over the last 12 months, we've probably brought on almost a half a dozen Metaswitch licensees. And so when we look at where we see the opportunity to grow, it's going to be pretty significant. These licensees, Sam, they can't make a decision and change overnight. They have to vet it out. They have to have a game plan, because it's a pretty massive task when you run your business on one platform for many, many years and you want to migrate it over. You really have to have a plan in place to do so. In fact, one of the licensees, one of the top 10 licensees for Microsoft, made a decision in November of last year to move over to Crexendo. They'd been with Microsoft for almost a dozen years. They took 4 years to evaluate our solution before they finally pulled the trigger. And so now that's a great win for us. So we anticipate the floodgates opening. We've already seen with bringing on a number of Microsoft licensees over the course of the last year. A lot of these licensees, when they have a great experience with us, and they all have, tell all their other licensee community that they have relationships with, that it's been a great transition. So we're getting a lot of interest and a lot of activity from Microsoft resellers out there looking at Crexendo for their alternative to make their change. Just to give you an idea of how many new licensees we added, Ron's got some color on that for the quarter.
Yeah, I'd like to also add the changes over the last 12 to 18 months. It really started before this end of life announcement from Microsoft, in that they have went through multiple rounds of layoffs of their customer service teams. And so as they've reduced their headcount and reduced staffing, the customers that need that support the most are the ones that suffer. And so this process of looking for an alternative has started over the last 12 to 18 months. And so we've started to see interest. The floodgates have opened, and we're starting to get a record number of interest from Metaswitch customers that are looking to talk to us for the first time or continue conversations about evaluating our platform. So the sales channel is looking very strong there with leads coming in. In the last quarter for Q2, 4 new logos were recorded. So that's 4 new customers that are installing the platform for the first time. During that same period, 8 of our 230 existing partners are adding to their services on a regular basis. So we had 8 upgrade orders during the quarter. That's comparable to 8 upgrade orders in the first quarter. As you may remember, we recorded 25% growth in the first quarter of this year. So accelerating growth, we're continuing to see upgrades, and those upgrade orders are coming in. The new logos are also coming in at much larger deals. So that's the reason why we had such a great quarter with that 35% growth year over year.
Brilliant. Thanks for sharing all that. A follow-up question is, I happen to, well, let me start off by saying, Microsoft is retiring this solution, but I think in Microsoft's mind, they probably hope a lot of their customers just go direct to Teams rather than using kind of a bigger provider. And I was wondering, I recently read one of your documents, which is, I guess, targeted at the Metaswitch customers and kind of outlining the factors they should be considering into when they're making their decision. And I was wondering if you can kind of give us a quick summary in terms of the decision-making process. Why would a customer not just go directly to Microsoft Teams and consider other options such as Crexendo? If you can add some color there, that would be great.
Yeah, so to put a little clarity to that, so Microsoft Metaswitch is a platform. Teams is an application. So Teams is really meant more for an end user individual business, where Microsoft Metaswitch is a platform that can be sold as just that, a foundation to go out and offer that service to multiple people. You couldn't sell Teams in a platform environment. It's not a platform, it's an application. And so when you think about all of these Metaswitch licensees, they've built their business on a platform that's very robust. I mean, some of these licensees, the one that we brought on in November, they've got a couple of 100,000 end users that are all in their own separate compartments on the platform. And so you couldn't do that in a Teams environment. You can't have multi-tenanted capabilities in a Teams environment. So these Metaswitch licensees don't have an option to move over to Teams. They've got to look for another platform. And so when they look for another platform, they may look at Cisco, but that's jumping out of the frying pan into the grease, because Cisco's basically taking the same game plan that Microsoft is and not really developing their product and alienating their clientele. So it really leaves them with other alternatives, looking at other vendors, and we're going to be the best choice out there for them to look at. We have a Teams integration on our platform today. So we have customers that may be using Teams, and they use us for their unified communications in combination with the Teams integration that we provide on our platform. So it's a very, very synergistic opportunity for us. So if somebody is considering Teams, we're still a good solution for them. But all of these Metaswitch licensees, they wouldn't consider Teams a possible replacement, because it's a left hand, right hand type scenario. It's nothing. Teams has nothing to do with a platform type offering, so they really don't have that as an option in their offerings.
Right. Well, I've asked quite a few questions. I'd like to kind of take the time to go to the audience, and anyone who has a question, just feel free to come off mute and ask it, or if you want to place it in the chat, go ahead and I'll read it out. So yeah, go ahead, anyone. And by the way, these questions don't have to be limited to the quarter. You're welcome to ask kind of forward-looking questions, about how things may move, competitive landscape, or risks, or anything on your mind. All right. While everyone's still thinking, then let's talk a little bit about your kind of growing cash position, and you're getting great cash inflows regularly now, and you're up to 13 million cash on the balance sheet and no long-term debt, and that's, I think, a huge asset. Why don't you talk a little bit about your what you intend to do with that cash?
Yeah, so very, very strong cash position that we've built over the last few years. That's driven by the strong top line growth that we've been experiencing and really getting that economies of scale with improvement in our gross margins, which is allowing us to put more cash to the bottom line. So it's really been a tale of firing on all cylinders, improving margins in both the telecom services segment as well as the software solutions. We saw 60% service revenue margins in Q2. That's up from 57 in Q4 of last year, and Q2 of last year, 58%. We also saw software solutions gross margins of 73%, and that's up from 67% in Q2 of last year. So that's a lot of margin appreciation, and a lot of that margin appreciation drops to the bottom line in the form of cash flow. Now we use that cash flow to reinvest in our products. So as we look at generating positive cash flow, we've had 4 great quarters in a row of positive net income and positive cash flow generation. So what we do is we turn around and we invest that through hiring employees and contractors to work on our platform and continue to develop that to keep it first in class, the best platform that can be out there. As we continue to invest in that platform, we've increased headcount. So from Q2 of this year to compared to Q2 of last year, we've increased FTEs by 12.5, and we've increased our engineering and customer implementation contractors by 10. So that's 22.5% increase in our headcount, most of which are working on our platform or on our sales functions. So we continue to reinvest in the platform and our business growth. It's really driving that growth. With the record 2 quarters this year so far, we're continuing to invest. So we opened up a lot of recs in July, and so we started hiring some more engineering resources this year. So we're going to continue to invest in our platform, but through bringing on the right people to help us develop that platform for the future. We also can utilize that to do inorganic acquisitions. But right now we've been focused on the organic growth and organic development of our platform. As we generate cash flow, we can use that to buy customer base from our licensees that are in the late stage of their life cycle and are looking for the retirement and looking for a home for their customer base. We've made it known to our customer base that if they're looking for a home for their customer base, we're happy to do an acquisition. And so we're generating that cash flow. We'll be able to use that cash flow to do acquisitions in the future.
Great. Well, we've also had 2 questions come in. Chris, why don't you ask anything on your mind first, and then I'll read one out from Gareth after that.
Sure. Can you hear me?
Yep, sure can, Chris.
Yeah, I'm curious. We talked a lot about this, Microsoft sunsetting, and I appreciate the difficulty in some of those customers migrating. My question is, do you think there's an opportunity for you, either with a partnership with an integration firm or some kind of incentives or rapid migration tools to kind of launch a more aggressive kind of safe harbor program where you could move more of those customers more quickly than they might organically?
Yeah, great question. And we actually already have that done. So when you think about moving from one platform to the other, we've done enough of these Microsoft Metaswitch migrations to where we've actually got custom scripting that's already available, so that if somebody was thinking about moving from Metaswitch to Crexendo, that scripting is already done, which makes it that their migration much, much smoother and much easier, because they don't have to go out and reinvent the wheel on how to move from application A to application B. So if you think about it, it would be like going from a Samsung phone to an Apple phone, is that there's similarities, but there's differences. You have to convert one to the other. That's similar to the platform. And so we've actually written with some of our licensees out there scripting to actually make that happen much more efficiently and much more smoothly. So that's available. And so we do highlight that with all of the Metaswitch opportunities that we have in the funnel, that's one of the main things that we lead with is that, hey, we've already done a number of these, and here's 6 or 7 references of your counterparts that have already done it. And with these migration tools, it makes it very simple for you. So we've already fast tracked that to these people and already aware of that. So we're aggressively targeting all of the Microsoft Metaswitch customers that we know of, and that's a pretty healthy list.
Is there any chance at all that Microsoft might want to be more constructive in partnering with you guys to assist their customers in moving off of this platform, similar to the many years ago Amazon said we don't want to be in the third party store business, so here's this company Shopify, they've got a great solution, we recommend it. Have you had a chance to, does it make any sense to talk to them, or how would they feel about it?
Yeah, potentially it does make sense. And actually that was another recommendation that even one of our board members brought up during our board meeting the other day. And it's something that is on our radar screen. The articles that we've read highlighted that, if you think about Metaswitch's acquisition by Microsoft 4 years ago, the estimate Microsoft didn't disclose, but all of the articles signified that they probably paid about $275 million for the acquisition. That's a rounding error for Microsoft. So when you think about their concentration there, they're focused on AI right now. They're focused on other things. And so, for them to look at this small division and not want to pursue it, makes sense from that perspective. So when you think about what their alternatives are, they could look at a partnership, and it's definitely something that we're going to aggressively pursue. Some of the articles I've read highlighted that Microsoft may look at jettisoning it and selling off that division. So, that's an option as well. We probably would not be interested in acquiring that, obviously, but, it could be something that if they sell it off, somebody else might try and stop the bleeding there. But right now we're taking full advantage of it. And most of the licensees that are wondering what the future direction is, they can't wait on seeing what the outcome is. They have to start making decisions pretty quickly.
Right. Yeah, it's interesting because Google did something similar when they got out of the domains business. They basically kind of anointed Squarespace as a partner. But anyway, I'm gonna leave that in the fantasy column and continue to appreciate all the great work you guys are doing. So
I appreciate it. If you've got any good contacts over at Microsoft, let me know. I've already left a message.
Yeah, all right. Maybe I can annoy them on LinkedIn at least. All right.
There you go.
I'll ask a question coming from Gareth. He says, can you elaborate a bit more what is meant by sessions in your billing and the difference in the structure between customers that use Crexendo directly versus the licensees that license the platform directly from you?
Great question. So if you think about our platform offering, that's the wholesale side. So when we sell a platform to one of our licensees, they buy it on a sessions-based pricing model, not a seats-based pricing model. And that's a huge differentiator between us and Cisco and Microsoft. Cisco and Microsoft historically are known for charging a seat license for everything that you do with them. And so if you have a unified communication company and you're looking at a platform, if you've got Cisco or Microsoft and you've got 15,000 end users out there, then you're going to buy 15,000 seat licenses from Cisco and Microsoft each and every month and pay for those seat licenses each and every month. That's their licensing model, and that's how they do it. When we came out with our platform, we came out with a disruptive pricing model called sessions, not seats. Because if you've got 15,000 seats out there in your environment, not all 15,000 people are going to be on the phone at any given time. In fact, the ratio is probably more like 20-1. So with 15,000 seats out there with Microsoft and Cisco, you're paying for 15,000 seat licenses. Or with Crexendo, you might be able to get by with 500 sessions as opposed to 15,000 seat licenses. And so that allows you to go out there and really arbitrage on the fact that you're buying for a much lower price point from Crexendo. And so the licensees that we have make a tremendous amount of margin compared to a licensee from Cisco and Microsoft. So it's a very disruptive pricing model, and it's one that our licensees love. And when we bring somebody over from Microsoft or Cisco, they love the fact that they're getting a platform that's just as robust, if not more robust, and they're saving in some cases 45 or 50% on what they used to be paying for their Cisco or their Microsoft platform.
Chris, you still have your hand raised. Did you have another question you wanted to ask? Okay, hand down. I guess not. Okay.
Yeah. Sorry about
Mike,
that.
did you have a question? No worries. Mike, it looks like you might have one. Is Mike gone? Is he there? He might not be there. Okay, let me ask another one then, which is, what since we've had a lot of discussion, in our chat boards at Breakout Investors, one kickback that we got was, that generally speaking, the UCaaS space is not profitable. When we look at the other players, they're not making anywhere near the money you are. How is this kind of relatively, you're not huge compared to a lot of the other players. You're actually a low cost provider. How are you able to generate profits when seemingly no one else can? I was wondering if you can share a little bit of your kind of secret sauce in terms of how you can, generate the margins you are compared to other people.
Yeah, I'll start and then have Ron add a little bit more color because this is a great question and something that we're very proud of. First and foremost, we've always focused on the fundamentals, and so we haven't ever over leveraged ourselves. I mean, you highlighted the fact we've got 13.5 million in cash and virtually no debt. Most of our competitors are straddled with debt, and so what they did is they over leveraged themselves and they accumulated a tremendous amount of debt. And so if you look at the losses that some of these guys have out there, it's because they're paying off huge amount of interest on that debt that they've accumulated over the years. So we've always been managing the business by the fundamentals. And so, I think that GAAP profitability has always been critical for us. We were GAAP profitable before we did our 2 acquisitions. We had the intangible amortization costs that put us into a GAAP loss over the last 2 years just from those acquisitions. But if you strip that out, 24, 23 consecutive quarters of non-GAAP net income is pretty important for us because we've always been focused on getting back to GAAP profitability, and we actually accomplished that 2 quarters ahead of schedule. We accomplished that in Q3 of last year. We weren't anticipating getting that until this year, and so we got to GAAP profitability because we managed to the fundamentals.
Yeah, that's right. I mean, telecom services is a very profitable business if you run it based on the fundamentals. You're basically going out and signing up customers to pay $20 a month for phone service for each desktop they have out there. Your costs are very immaterial in relation to the amount of revenue you're generating from that customer base. So it revolves around your customer acquisition costs and then your normal cost of sales and G&A. And so, one thing we focused on is not going out and trying to compete with the likes of RingCentral and paying these large amounts of spiffs where they're paying 10, 11, 12 times the monthly revenue as a spiff to the sales rep that brings in the deal. They're more focused on getting the customers and getting economies of scale. But what they don't realize is they're taking on so much debt by funding that sales growth pipeline that ends up hindering their ability to show profitability. And so we've always focused on growing at a much slower pace because we invest in our business based on the profits we generate from the business. And it's really the best sustainable way to grow your business. So yes, maybe we sacrificed growth a little bit along the way, but I think it's paying dividends now that we're able to grow a profitable business and show that we can be profitable, have margin expansion, and continue to accelerate our growth and reinvesting our proceeds.
I imagine that one of the aspects of why your customer acquisition cost is lower is just simply because you have the best product out there. And that's kind of well documented on review sites and things like that. So I just wanted to point that out. Mark, you had a hand up, so go ahead.
Sure. Say, great job, guys. How does all this movement with Microsoft and the potential movement with Cisco, what has that done for your hiring? The hiring environment as it pertains to getting good talent out of Microsoft and Cisco? Has that had any impact?
Yeah, good question. We did hire just a recent hire from Ring Central. So Ring Central also had a pretty large reduction in force recently. So we hired a senior VP of customer service and customer success. So that person just came on board within the last 90 days. I think we've just recently hired somebody from Cisco BroadSoft background. We haven't hired anybody from Microsoft Metaswitch background yet, but I know that we've got a couple of interviews lined up with folks that have just recently been cut there. So it does give us an opportunity for good talent. Finding good talent out there, as everybody is aware, is a mission critical task, and it's a very difficult task. And so for us, being able to find somebody that's already vetted in the space is a home run for us.
Great. And what do you anticipate will happen with the pricing environment here? If you get the top two players somewhat dead in the water with a pricing model that adds up to being significantly more expensive than yours, it seems to me that it would be kind of common sense that your pricing power will increase over the next few years. How do you guys think about that?
Yeah, you would think so. It's still a very competitive market out there. Although we're the third largest, there are some folks out there that are not far behind us, and so they're going after the same market. So although I'd love to be able to say that we've got price flexibility to where we can increase our prices, it's also a very competitive market out there. When I go in and I talk to a Metaswitch or a Cisco licensee, and I tell them I can save 45 or 50%. That's fantastic. But if somebody else comes in and tells them they can save them 75%, then that's that competitive nature. So, I think what we look at is trying to package our solutions to be the best value out there. We're constantly improving our platform with enhanced features, enhanced capabilities. In fact, most of the new capabilities that we're adding to the platform today have AI associated with them. So AI is a big buzzword out there in everybody's industry, but for most people, it's a future discussion. And for us, it's a deliverable today. So a lot of our applications are deliverable today using AI functionality in the system. So we're pretty excited about where we are. Price wise, we have had a few increases on our platform side of the house over the course of the last 2 years, but we're very judicious about that and make sure that it's a very planned out scale, especially with our existing licensees. They know that when they put the platform in, they're a very, very sticky customer. And so we want to make sure it's a symbiotic relationship. We don't want them to think that we're trying to price gouge them once they have the system in, that every time they need to do an upgrade, it's outrageously expensive. And that's one of the kickbacks that we hear back on Cisco and Microsoft, is that every time they want to do something, it costs them an arm and a leg. We've got a good relationship with our clientele, and that's why our churn on the software solution side is virtually nil. On the direct side of the house, our prices have been pretty consistent for our end user businesses. We tend to add more features and capabilities to the platform as opposed to lowering the prices. So features like texting from the business application, the AI enhanced applications like marketing on hold that we just added, all of those features we add, and we don't increase the price. So it's kind of like laptop computers. They keep increasing all of the capabilities and the speed and the processing power and the applications on them, but the price never seems to come down. So you just get more bang for your buck. That's kind of what we're doing on the retail side, is that our average price per user on the retail side is about $21 right now. That's been pretty consistent for the last 2 years, but we continue to add more and more feature functionality into that price per user as opposed to lowering the price point.
Great. Then any kind of just a sense as to what the operating leverage looks like in one side of the business versus the other. Obviously, you've got better margins on the software solution side, but when we look at the operating margin part of that, how much more leverage do you have from that solution side? Because obviously that side's growing faster and seems to have a great opportunity to continue growing pretty fast over the next couple of years with this Microsoft Cisco situation. Just trying to get a sense as to how much might drop to the bottom line over the next couple of years.
Yeah, no, it's an important aspect of our business. So as I talked about earlier, the improvement in our gross margins, obviously in a software business, software, you can get upwards of 80% margin on a software. So, as we continue to get economies of scale, we're seeing that improvement in our gross margin, with it being 73% in Q2. Over time, over the next year or two, it's going to continue to increase as we continue to get an inflow in new customers and new existing customer upgrades. And so I think we're going to see a lot of expansion there in our gross margins on the software solution side of the house. On the telecom services, for as long as I can remember, we've historically had 69 to 72% gross margins in our service business. When you mirror in the product items, which is a much smaller component of our revenue, there's fluctuations in product revenue based on device, the type of product you're selling, and from one quarter to the next. So that does have some impact. But so that's why we focus on our service revenue. What you see today of 60% gross margin, that's been impacted by the acquisition of Allegiant, because they had MSP services, data services, as well as UCaaS services. And so their service offering is a little more, has a little more cost of sales associated when you're providing MSP services, because you have the resources available 24/7 to support those customers. Although they have a higher revenue per seat, it also generates a higher cost. And that's what's impacting our margins over the last year since that acquisition, where you see our service margin being 60%. But if you were to carve out those additional services, the pure service margin is around that 70%. Is there much room for appreciation there? There is a little. It's like any business, economies of scale, the customer support, the customer service can be leveraged as you grow. But what we continue to focus on, and as you mentioned earlier, Sam, is one of our selling points is our great customer service and our ratings out there on the G2 app. So we continue to invest in our customer service, which is a direct cost of sales for providing telecom services. And as we continue to invest in our customer service and implementation teams to support our growth, we've been able to maintain that gross margin. Could we have leveraged that and not added customer service reps and got higher gross margin? Well, we may have suffered on our service ratings. So we continue to invest. We think 70% is a great margin. It's profitable at that level, and we can make money on that, both sides of the business in that range, 70 to 73%.
Yeah, and as we look forward the next couple of years on the operating margin side of the house, is there a target that you think you guys can aspire to there without?
Yeah, I think we're at 4% in Q2, and now, so it's improved from last year when we for the full year when we had loss in the first two quarters, and so we're really getting back to that. The profitability and the top line revenue growth is allowing us to generate operating margin at that 4% range. We had goals of getting it back to 5% this year, and we're already 80% of the way there. We think long term. So if you look into next year, there's no reason that we shouldn't be at 10 to 12% operating margin, and you can get that up to 15%. And at the same time, if you're getting operating margin up to 15%, you're getting 20% to adjusted EBITDA.
Great, thank you.
All right, Mark, if you're done, you can lower the hand, and I'll ask about what one thing that came across in the earnings call was that your international growth is going very well. So I was wondering if you could elaborate on that aspect and the opportunities ahead. I know that it's kind of they're not quite as far along the process of acquiring UCaaS solutions over there, and how the progress is going.
Right. Yeah, if you think about the adoption rate of cloud communications here in the US, it's about 60%, which means about 40% of the businesses in the US still haven't migrated to the cloud. That's still a tremendous amount of runway that we've got there. And so we're looking forward to taking advantage of the tremendous opportunity here domestically. But internationally, that adoption rate is more like about 40 or 50%. So there's about 60 or 70% still left in the or 60 or 50% still left for growth in the European market, and it's even less adoption down in Australia, the Pacific Rim, and South America and other areas. So if you look at our growth internationally, it used to be a non-material number, and this past quarter, it's actually a material number for us. It's
6%.
6% now. So we're seeing great growth there. So if you think about over in the UK, that's where Metaswitch was headquartered. So a lot of Metaswitch opportunities over there in the UK market. So that's a good opportunity for us. Cisco is extremely well positioned with their BroadSoft platform globally. So last year, I think in November of last year, we had a press announcement of a big Cisco BroadSoft licensee that we moved over in Australia to the Crexendo platform. So we see the international opportunities being extremely significant for us. That's only on the software solutions wholesale side. We aren't selling retail direct to end users outside of the U.S., but we see tremendous growth opportunity on the software solutions side internationally.
And one thing I'd like to add there is that our investment in OCI, our infrastructure investment with Oracle, is going to allow us to expand internationally at a greater pace. Today we have 2 data centers internationally, and that's been able to support our growth in the UK and Australia. Various countries have various regulatory requirements and require specific data center and points of presence within their country. So as we expand and fully build out our OCI relationship, we'll be able to turn up data centers internationally at a much faster pace, just by running the scripts and turning up a location. So it really opens the door for us to expand internationally at a rapid pace.
Right. Another aspect of the business which I think deserves to highlight is just your team and the strength of your team. And I was wondering if you could do a little bit of kind of self-reflective thinking and just kind of share with us kind of what's the maybe top 2 or 3 strengths of your kind of management team. Where do you kind of shine? If you didn't mind being a little bit proud and
I think the key component here is that we've got a great working management team. Starting with Jeff Korn, our CEO, and myself as the president and COO, and Ron as the CFO. Jeff, Ron, and I have been working in tandem now for 12 plus years. And so we can finish each other's sentences. We think alike, and we know what we need to do to manage the business. Our Chief Revenue Officer, John Brinton, I've worked with John for 25 plus years. He was at our prior company, a company called Intertel and Mitel before Crexendo. And so John is our Chief Revenue Officer, and again, extremely well positioned within the organization. So having a core nucleus like that concentrates on running the business is critical. The acquisitions that we've done with at Sapiens and Allegiant, we were able to keep the top level management on there and have them synergize into the team. And we've got great working relationships there as well. So, I think what makes us hit on all cylinders is the fact that, we're all focused at the same thing. We're all focused on top line growth. We're all focused on cost management. We're all focused on the fundamentals of the business. And we all realize, and we all are shareholders ourselves, that, at the end of the day, we're here to provide the best return for our shareholders. So, we don't over leverage. Every decision we make is, hey, is this going to benefit the company and benefit our shareholders? And I don't think you get that with a lot of management teams. I think a lot of management teams are just all over the board. We're focused, and for some of the folks that are on the call here, you've talked to us for years and years and years, and every year that you talk to us, we've made commitments, and all of those commitments have come true. I can just guarantee you that when we talk about what we're committing to, we come through with that. We used to be on the OTC. We said we were going to organically uplist. Everybody said, well, that's tough to organically uplist. Well, guess what? We organically uplisted. We talked about getting GAAP profitability. Everybody said that's difficult to do in your sector. Nobody's making GAAP profits in your sector. We are. And so all the commitments we've made over the years, we continue to meet and exceed.
Brilliant. Thank you. One last question from me before I check in with the audience again is, I was wondering if you can kind of talk a little bit about your acquisition strategy. What kind of companies are you fishing for? How might they look in terms of profitability, size, and what kind of pace are you hoping to acquire companies?
Yeah, I'll start with what we're looking for, and then I'll have Ron give you the financial aspect of what we try and accomplish. So when I talk about our acquisition strategy for us, 5 years ago when you asked me that question, Sam, I would have said, hey, we're looking for anybody that sells telecom services. But since we acquired NetSapiens 3 years ago, we got that wholesale side of the house, the software solution side of the house. And at the time, we had 170 licensees. Now we've got 230 plus licensees out there using our platform. And I commonly refer to that as our stock fishing pond for future acquisitions. These guys are part of our community. They use our platform. They run their whole business using our platform. We've got great relationships with them. They've got great relationships with us. And we've told them, hey, if you're looking for an exit strategy, come knock on our door. If it's a good fit, then hopefully we can put something together. That's what we did with Allegiant Networks. They were one of our licensees, and when the opportunity came for us to do an acquisition, they were one of the ones that jumped in line, and it was a perfect fit for us, and it's been very accretive ever since. So our acquisition strategy is looking for the right acquisitions that are going to be accretive and synergistic. And so as we look forward, with those 230 licensees, at any given time, some of them are looking for an exit strategy. And so we've always got multiple communications going on. We're not going to overpay. Ron will talk about what we look at and how we value these opportunities. But for us, there's plenty of opportunities out there, but we're looking for the right opportunity, not the first opportunity.
Yeah, that's right. And so we also look for a concise product offering. So we look at these licensees that are on our platform and our stock fishing pond. We're looking for that customer base that has the majority of their customer base on the platform. And the reason why we do that is because we've had many acquisitions in our 12-year tenure here where we've done acquisitions on disparate systems, and you have to migrate those customers over from their platform to your platform. You have to touch every one of those customers and handhold that customer because they're disparate systems. Now that we have this platform and 230 licensees that are selling our platform, those customers, if we were to migrate those customers from that licensee's data center to our instance, it would be seamless in almost all cases. So the customer wouldn't be impacted by that change because they're not moving from one system to the other. They're moving from our system to our system. And so focusing on that fishing pond gives us that opportunity to do a seamless acquisition where we can migrate those customers over seamlessly. Now, that's the reason why we focus on our stock fishing pond. And within 230 customers, every one of those customers are in a different stage of their life cycle, but there's just as many at the end of their life cycle as there are at the beginning of their life cycle. And when they're looking for retirement, they're looking for a home for their customers. If they were a local business, they sold in their local community. If their friends, their family, their local community that they were selling phone services to, when they're done, they don't want to just wipe their hands and say, I'm sorry, you're in good hands. Hopefully they take care of you. They really look to find a partner that's going to take on those customers and provide the same level of customer service that they provided, especially if it's their friends and family and local businesses that they see every day. So we're the perfect choice there because we're going to keep them on that platform. We're going to make it seamless. But then you get into the financial aspect of it. On an acquisition, we're looking for acquisition targets that are in that late stage where they're looking for a new home for their customer base, and we're looking at paying a multiple of revenue in the telecom space. Most acquisitions in M&A space are valued on a multiple of revenue because they're long-term recurring contracts, and so they're typically valued based on a multiple of revenue, not on a multiple of EBITDA. Because most telecom companies in our space or in the legacy telecom space are losing money, so they don't value it on their profits. They value it on top line revenue. So we've really perfected our model over the last 12 years to really hone in on what is the right price to pay for an acquisition. And so we think the right price is somewhere in that 1 to 1.25, 1.5 on the high end of what we would pay on a multiple of revenue for long-term contract customer base. And that's accretive to us. That's similar to our current customer acquisition cost of one or two acquisitions at a time. And so if you can keep the acquisition cost or the M&A cost within line with your traditional customer acquisition cost, then you're not over leveraging to buy that customer base. So we can see an acquisition being accretive to our operations within 1 or 2 quarters after the acquisition if we purchase it right. If you were to pay 2, 3, 4x times the top line revenue, you gotta support that customer base for 5 years before you're going to get even a dime return on your investment. And so we look at a model. It may not be for everyone. Private equity likes to sell at 2 and 3 times revenue, and we may not be the purchaser for that customer base. But for the average customer, selling their customer base for 1 to 1.5 their top line revenue is a home run. And so we really focus on ones that make the best fit for us, and there's plenty of them out there for us to do acquisitions. And I think that sums up how we try to price those acquisitions and how we like to get a return on that investment.
And we've looked through the model together, and what impressed me is I haven't got it in front of me now, but something like the cash flows which you expect to generate after you've kind of stripped out all those costs, and it's immediately accretive, becomes more accretive. You're talking about a payback period for the whole acquisition of 4 to 5 years or something like that, if I remember correctly. And that's I
correct.
think really noteworthy. So I wanted to highlight that. We're nearly out of time, so I just wanted to check in with the audience one last time. Any more questions? Go ahead. Looks like no one's got their hand up. So I will ask my last. Go ahead, Doug. You look like you want to say something.
Yeah, it looks like one just came in on the chat there. So from Gareth.
Oh yeah, sorry, yeah, that did. He says, regarding the reseller market, are you seeing any consolidation or any other industry changes occurring there? For example, any of your licensees growing through acquisitions? And may change at Microsoft impact consolidation in the reseller market?
Yeah, one thing about the telecom space is that there's always active M&A going on. So some of our licensees have combined over the last year or two. So we actually have seen some of our licensees get together with some of our other licensees. So that has happened. Some of our bigger competitors out there, UMA just acquired one of our platform competitors on the wholesale side at the end of last year. So we do see opportunities out there that are happening. For us, there's Vonage just got acquired by Ericsson a little bit over a year ago. So there's always changes going on in our telecom space. We don't get distracted by those, and we're focused on our mission and our mission only. And we know that we're going to continue to execute on our plan. So when other acquisitions happen in the industry, that's great for us because it creates fear, uncertainty, and doubt. So when we look at the Vonage acquisition by Ericsson, that's been a train wreck. Ericsson just wrote off the majority of that acquisition over the course of the last couple of months. So that's created a lot of opportunity for us because the Vonage customers and the Vonage people are looking for an alternative. RingCentral just had, as I mentioned, a large layoff. We were able to get a great senior executive to come over to our team from that layoff. So as I see opportunities out there with our competition having challenges or merging together, that creates more opportunity for us.
I think we'll wrap up there, 5 minutes to the hour. Just wanted to thank Doug and Ron for giving us so much time. It's really a pleasure every time we chat, and I really think this is a brilliant team, brilliant company, great opportunity. So I know the audience was happy to get a chance to ask their questions, and thanks for giving us the time today.
Thanks, everyone.
Thanks, Sam. Thanks, everybody. Appreciate it.
Neither Breakout Investors nor any of its affiliates makes any representation or warranty, express or implied, as the accuracy or completeness of the statements or any information presented by this podcast, and any liability, including in respect to direct, indirect, or consequential loss or damage, therefore is expressly disclaimed. The views on this podcast expressed are those of the speaker and not Breakout Investors. No one on this podcast is an investment advisor, and no one is providing investment advice. Before investing in any company stock, you must do your own research. Thank you for listening.